class. Today we're going to address two topics, and the two topics are going to be as follows: trading plan, precautions for emotional stabilizing while trading, and invalidation levels and SL. So, invalidation levels is very different from an SL. It's very different from your stop loss. Your stop losses are different from your invalidation level. So an invalidation level is a level where you know that there is no how. If price comes below or above this level, this trade has failed. This setup is not valid any longer. That's what it's called invalidation levels. So a level where price is no longer valid for the setup you felt or you believe it's supposed to run for. While an SL is a level or a line where you believe that is, if price breaks below this level, you are already in loss already. So everything is done because of risk management. So invalidation levels can be on higher time frames. You can see those levels on daily, see those levels on a weekly, and some other levels on 12 hours. So I will give you an example as we are taking the class. I want the class to be short, as brief as possible rather. Why an SL? An XL, when we draw SL, stop loss, we believe that if price was rejected off our level, you set your stop loss when you open a trade. It's very important to understand that. So you first of all have an invalidation level. When the trade now obeys exactly what you want, you now enter your trade and set your stop loss. So sometimes we can use stop loss and invalidation level interchangeably, but you have an invalidation level before you execute your trade. It's the moment you execute your trade, you set your SL around that level, believing that price is already in my direction. I don't expect price to come back to that level. Before you begin to look for how to take your zero risk. Okay, so trading plan. What is a trading plan? So we all know the saying that he that fails to plan will definitely fail. So anybody that fails to plan for any single situation, just like those that plan for incidents, those that have insurances, they are planning for things. Not that they wish these things to happen, but it's always good for you to plan for these things prior to them. Just in case it happens, you already have a procedure on grounds to follow on how to recover and how to get back yourself on track. So we're going to look at every single topic, and let's just start our class. What does it mean to trade a plan and plan a trade? So, like I said, trade a plan and plan your trade. Meaning, you first of all plan the trade. After planning that trade, you now trade that plan. So you plan your trade before your trade is about to play out, and you trade that plan for that trade setup. So let's put zero risk. Okay, so I'll add this topic to you to make it interesting. So what is my SL? So when you're planning, I think the most important requirement for your planning your trade is two questions. What is my plan for this trade? The reason I put this question as the first question is because of when you have a setup that looks so beautiful, you just want to execute. So if I start asking myself about what is market structure, what do I see, I will see things that will make me execute, and I'll go and execute the trade without even planning. So the first thing I ask myself is, what is the plan? What is my SL? What is my invalidation level? What is my entry? Where is my TP for this? What is my plan? And you draw it out exactly. I'm entering at 1.00 this. I'm expecting price to reject at this level, and I want setting here as my stop loss, and I'm setting here as my take profit. And when you're planning your trade, you want to have a minimum of 1:4. Your minimum of 1:4, meaning your risking 1% of your account to get a minimum of 4% of your account. So 1 is to 4 RR, which is risk to reward, which is the minimum you're interested in getting on your setup. So what is my SL? Where is my entry? These are the questions. These are the first questions you ask yourself. This is all parts of the plan. Where is my take profit? And what is my risk to reward? Which is this. The reason I'm touching this topic lightly is because of the book you just finished up. That book explains to you. You've seen people's different trading plans. You've seen people's situations in the market. You've seen people's experiences in the market, and you can use that to make decisions for yourself as to how you want to go about your setup. So, but you must have a plan for every trade setup, because without a plan, you most likely will have emotional instability while trading, because you don't know exactly, if something goes wrong, you're already shaking because you don't have a plan. You push your stop loss higher, push it down, price will just play with you, your emotions. Why? Because your emotions is not dependent on the plan. So if you have a plan, you follow your plan. If your plan fails, at least you were able to follow your plan. That shows you're a disciplined person. So let's continue. Why am I taking this trade? This question is very important because you need to know exactly why that setup is worth planning for. Why is this setup worth planning for? What did I see the daily structure previous? What was the market structure? What did I see previous to the daily structure? Am I seeing fair value gap on 12 hours? I'm saying this in respect to this our trading setup that we have. Am I seeing fair value gap on 6 hours? You understand that 12 hours and 6 hours is just for direction of the day. Is worth taking. So all these different levels, you set alerts on these levels. Because if they are filled, it's a very wonderful sign for you to take an opportunity. Set alert on this level. Set alert on basic level of them, but this is for direction and this is for your trade execution. So what is each time frame telling me as regards to market structure? As regards to market structure, as regards to your setup, what is each time frame telling me? And these are the questions we ask ourselves. So now we're talking about psychological levels. Now, psychological levels, which is invalidation levels, or which is our this psychological levels, are lines, are areas. I always call them lines because I use psychological levels for 12 hours. I use it for monthly self, from monthly time frame to weekly to daily to half a day to 6 hours to 4 and to 3. Now, I call them lines now because what I do when I set a price alert for a level, like I've seen 6 hours IPA or I've seen 12 hours IPA, I draw a line at that IPA field, and what that line signifies is simple. That line is a psychological level for me. That line means when price comes to this position, above that line is buyers, below that line is sellers. So there's a constant battle between buyers and sellers at a particular point in time. So from when I say fair value gap, I expect price to come back to that level and reject it. And when it crosses above that line or that level, I believe buyers have taken control of the market. So that line becomes like a separation between this is where sellers are, this is where buyers are. Buyers are above, sellers are below. So it's the same way I take to set up, uh, used to trade setups on 3 hours and 4 hours, on 6 hours. These are all psychological levels for me, because all I know is in regards also working hand in hand with my setup, with my strategy. 6 hours, 12 hours, 4 hours, 3 hours, daily, weekly, and monthly. Once price rejects my level and closes above a level, depending on your time frame, on the hour you want. For example, if you're trading monthly, price closes above a level on 1 hour. It closes bullish. If you're looking for buys, good. It's a good sign that price has closed bullish. I can execute a trade and set that level, the one that price had break below, as my evaluation level, as my evaluation level, and where price rejected to turn to buyers as my SL. Then I keep that same thought. All I know is that if I draw a line for fair value gap, above it is buyers, below it is sellers. So every single setup you have, every single trade strategy you have, has to have its own trade book. Just like a captain, you understand? Every situation you experience in the water, there is already a trade plan. If you're experiencing pirates, there is already a trade plan. There's already an engagement plan for pirates. There's an engagement plan for vessels. There's an engagement plan for submarines. As you encounter them on your journey to your destination, as a captain on the sea, if you see another ship that is hailing you, there's an engagement plan for every single thing. So this is done because we have something to follow on. We won't be shaken when things come, because we already know that this is the plan we'll follow. So a trade book is in line with your trading plan. So a trade book is, this is my trading plan for this kind of setup. When I see fair value gap on 4 and 3 hours, this is my trading plan. And that trading book answers every single question here. Where do I set my SL? Where is my entry? Where is my TP? What risks and reward can I take minimum? Why am I taking this trade? What are the things? It has to answer every single question. What are the things I'm expected to see? You understand? And what all the time frames, are they pointing to the same direction? Then you know how to engage. Sometimes understand that the market is not perfect. So sometimes you might have 12 hours, 6 hours, 4 hours, and 3 hours. You might even have a overall structure on the weekly different. So, but take what you're seeing there. Understand that the higher the time frame, the more power it has. So now this is very important. As regards where I'm expecting to close my SL, I'm targeting demand and supply zones, one. But also I'm targeting timing. So if I see a fair value gap on 12 hours, I know that the next hour, 12 hours, when price comes with my setup, it will run for 12 hours only, which is equal strength. 12 hours will begot 12 hours of strength. 6 hours IPA, fair value gap, will give you 6 hours of running strength in your direction. If price decides to continue after that 6 hours in your direction, is a good thing. But after that 6 hours, you know that price has exhausted its first strength of 6 hours. So if I say set up for 4 hours, I'm expecting price to also run for an equal time of 4 hours in my direction. If price decides to close above and continue, good. The same thing for 3 hours. So your setup in respect to your time frame is also in respect to where you're expecting your TP. So your timing and your supply zone or demand zone might hit at the same time. So in the next 4 hours, if you're on a 4-hour setup, price can hit our supply zone at the same time and begin to reject. That is our first TP. If you see that price on a weekly or time frame is bullish in line with your direction, then that is a confirmation for you to keep holding your trade. If you see that same setup on weekly, it also tells you the same thing too. So you take that and execute it. So that's the psychological levels. You have your trade book planned for each thing you're trading. Each thing you're trading, you have a trade book. Each setup you see, you have a trade book. There is always a plan. You are an artist in your craft. There is a plan for everything. You're an engineer. There's a plan. You're a captain. Your decisions are the ones that determine the outcome of your trade. So how do I engage opportunities? You engage opportunities with one-mindedness, simple and short. This is my setup. This is my plan. My plan is either my plan will work or my plan will fail. There are only two outcomes of my plan, but I will hold it to the ending. Simple and short. That is it for you. As far as your trade setup is 1 to 4, 1 to 5, if you're risking 1%, you most likely are going to get 4% and above. So if you fail that trade, the next trade will cover it and you'll still be above 3%. All the same, this is the minimum you can get, 1 to 4. So, but you engage it with a simple mindset. It's either TP1 or SL. So when price has gone a very good level above, I normally use, let's call it 50 pips or 100 pips. Each commodity is different. When price has done that, you now push your SL to your open of price. Where you opened your position, you now push your SL to that level to ensure that now you have zero risk on your setup. So if price comes against you, you're losing no money. But if price is your TP, you're gonna get money. So now you have zero risks on your setup. So because you have zero risks on your setup, now you can decide to engage another 50% of that particular position and let it run extra. So you can engage more. Now you have zero risks now. So but when you engage more, you must also plan that engagement, that extra setup, extra trades as regard to your position. So if you're already running 50 pips and you believe that price will run more to your TP, you can enter 20% of your previous position. So if I entered one standard earlier on, I'm not going to enter 0.2, one position. It's because you're opening yourself to more risks now, and since your opportunity has increased, you need to reduce your risk also. So it's either is your TP or your SL. That is just the result of it. I'm going to take it to the chart to also explain. I think according to the book we just went through, you can also be able to draw out your trade plan. That book is exactly what you need for your psychology, and that's why I also went through it to study it a bit and send to you. Finished it to the ending, and it is with that book you will draft out your trade plan as respect your analysis and this thing I just have taught you now. So you have to draft that out and send a copy to me, so I can also reflect it and compare it to my own. I will not give you an example. You just most of the examples you're looking for are already in that PDF I sent to you. So you will go through the PDF and create your own book. Then we can examine them together on our next class. That's what we'll do. And I believe you'll be alright. Invalidation levels, trading plan, and the precautions. The only precaution for emotional instability. The precautions, yes, the precautions for emotional stability and to avoid instability is just having a plan. Have a plan as to regards your executions, and you'll be alright. And stick to your plan. It's very important to stick to your plan so that you can make the most out of what you have. And you operate without fear, without emotions, because you already know that there are two outcomes to your trade, either TP1 or your SL. That's just what it is. It's not more than that. So embrace, understand your risk. Understand your risk, because when you understand how much you're losing and you understand how much you're gaining for just the setup, it will help you not to shake. Most time people open positions over leverage positions. I'm supposed to risk 10% or 20%, I now risk 90% of my account. So if price decides to play with me a bit, my heart could be beat. My heart is going to be beating because I didn't understand my risks before I opened the position. So, but when I understand my risks, I can execute well. So this is just what it is. Let me show you a brief example on the chart of what I'm talking about. A brief example of what I'm talking about on the chart is yes. Let's just look at this. Let me use let's use let's use 2 hours. Let's use 2 hours and let's use it on US 30. Let's use it on US Tech. US Tech could be okay. So I'm gonna use this setup here, this one here. So on this day, this was uh, the 5th of November, and like what we trade, like I told you, break and retest. So this is what rejection, rejection, rejection. The candle I'm interested in 12 to 2 broke and closed bullish above my level. So when price rejects, becomes a resistance level, and price breaks above that level, I'm expecting the next hour, 2 hours, to come down, reject at my SOB, and give me a setup to the next level of rejection. So our TP will be from here to here. I'm expecting price to reject and give me. So from here to here is our TP. We'll be targeting around here for our TP. Even with Fibonacci, it tells us what to do. So let me introduce to you Fibonacci at once. Fibonacci, where are you? Fibonacci retracement is what we're going to use. So what we do is we have a low for every single variable that we have on chart, and we have a high. So when you initially come for your setup, you have two things, and the two things you see are these rejections and price breaking out. So you have a high and you have the low of that particular setup. This is a low, this is a high. Since I'm looking for buys because this candle closed bullish, I expect price to come down. So I put my 100 above and I put my 0 on that lowest point the week. I always want to use it at 30 minutes, but I'll see it. I use week or body, but I prefer week so that I can get the whole gist of the whole thing. So in this setup, I'm always targeting 180% or a rejection level supply zone. It's not targeting. So I'm either targeting here, and it's in line with my 180, so I just keep it at, because price can still run extra. So I target demand and supply zone. In this case, I target the supply zone where sellers are. So this was my entry. This is my trade. This was a very nice setup. And now, what I'm saying to you, the reason I'm explaining this setup to you is because of this information I texted you on the group. Is when November is approaching, there is daylight shift. So our open bell is now by 3:30, meaning we are looking for now pre-open bell. We're looking for 12 to 2. On your trading view, it now becomes 1 to 3, 2 hours time frame. We want price to give us a fair value gap by 1 to 3. Remember, by 3:30 is our NYC bell. So by that 30 minutes, price will come to your level, reject, and give you your setup. So on US Tech, US 30, US 500, that is the setup. It is now 12 to 2 after the daylight shift. From time to time, you begin to see 3 and 4 coming gradually as the year is coming to an end and to the next year. So, but there are cycles of the market, and each cycle is defined by daylight shifts according to our strategy. Another setup again that happened was right here, the same 2 hours. So you could see rejection, price broke by our 12 to 2 and came back to reject it to drop. So when November is coming, daylight shift is coming, price begin to now conform to that 12 to 2, which is 2 hours fair value gap. So pre the NYC bell, you see setup. NYC bell comes, give you your entry and runs for you to your TP. So it's 2 hours, 3 hours, 2 hours, you're done. Highest 3 hours. This case, an example was what? 2 hours, 1 to 2, and this third hour, price already hit our TP on 2 hours already. So you're done with your setup in 2 hours. And so now you're sticking to one thing, 12 to 2 only. And only for US30, if you see 1 hour fair value gap, then you can work with it. But US Tech is 2 hours, 2 hours. This is another example on US30, 12 to 2. Another example was here, 12 to 2 hours on this particular setup. Look at this day. Price did not give me 1 year on 12 to 2, and price hasn't given me since on 12 to 2. So I want 12 to 2 to give me a fair value, but look at US Tech. On the day price did not give me 12 to 2, US Tech gave me its own 12 to 2. So you complement the two of them together. For US30, I want to have 12 to 2. I can decide to see 1 hour after a fair value gap, which is this. Let me take it to 1 hour, which is this. So rejection, rejection, rejection. Price breaks during NYC bell 1 hour. Price will come back, fill it up, and drop. So I'm going to use this as an example. This line you're seeing here is a psychological level. Why? I believe that at the close of this candle, sellers are below here, buyers are above here. But because of the fact that this candle closed bearish, I believe that sellers are below here. So I'm favoring the sellers this time around. So when price comes above here, the moment price breaks below here, since this is 1 hour, I would rather use 3 minutes. I would rather use 3 minutes. So I want the candle on 3 minutes to close below. It must close. So look at it. This is when the time closed right here. So I'm waiting for price to come back above that level. Close bullish, close bearish below this level. At this trade setup, once price closes bearish like this, I have a trade setup. And I'm going to target price. Since my wick is long, I'm going to target this high here. My wick is long, so I'm targeting this high here. This high. As my stop loss. So this is the sound 1, 2, 3. When I come, I'm only going to take 1 hour after fair value, after NYC bell on US Tech. There was a setup like that on US30, just like this, rejection. NYC bell came in, price gave me a setup on US 500. But I want to be sticking to US Tech for that 1 hour because it's later for me. But 2 hours is for everybody. So let's put Fibonacci retracement on this setup. We're taking this high. And we're taking. Because if we were to take this, we expect price to roll more for us. Okay. So that ends our video.